All right, I'm going to go ahead and get started. We have several people on the line. Thank you very much for joining. My name is Karl Baker. I'm the managing member of Baker CFO Advisory, a fractional CFO and accounting and consulting firm. Again, I just want to say at the onset, thank you very much for being here, for being willing to spend your time. This will be recorded, so I'll also just say thank you to those of you who will eventually watch the recording and for spending your time with us. We are starting a series throughout 2025 and beyond in which we're wanting to just anticipate and answer questions that people have. Why are we doing this? We're just wanting to help people in any way we can. And we're just trying to anticipate the issues that business owners are having out there on a day in a day basis. So we've been thinking about topics that we know are important and germane to people as they're running their businesses, and what we can do as financial leaders and accountants and in answering some of those questions. So I'm certainly in this particular webinar, we're going to talk about cash flow, and I have some comments about that, but we'll be looking for other topics. We have some other topics which we'll address at the end of this seminar. But if you have questions, comments, ideas, things that you're looking to address, looking for us to address, or questions that you'd like to talk about or listen to us about, please do reach out either through the comments here. You probably found us on social media, so ask us there. My email will be at the end of this session, and you can also find us on our website, bakercfoadvisory.com, and there is contact information there. And in any of those cases, just reach out to give us ideas about what you'd like to hear from us. So again, let's get started and talk about cash flow. The way I wanted to start this is I envision there are people listening to this now or in the future that, like me, maybe used to be in a corporate environment. And I was just thinking about the contrast between working in a corporate environment where you are a W-2 employee and you're doing your best day in and day out and you're working hard, and you don't really think about cash flow. You're serving customers or clients in whatever business you're in, and you don't really think about the management of cash flow. And what you think about is every 2 weeks or once a month or every week you get a paycheck, and that's your cash flow. But there are issues involved in a day-to-day business, and if you maybe used to be in that setting and you've converted to being a business owner, my guess is at some point you went, whoa, there's a cash flow issue here. We actually have to manage. We have to ask somebody for cash, or we have to pay somebody in advance of having that cash, or we need to figure out financing. So owning a business obviously is very different than being an employee, and there are real issues with managing cash flow, and there are strategies involved. And I just want to talk about that today. We're going to spend 30, 40 minutes. But again, we're here really to answer your questions. So I will certainly give you some tips and tricks and some strategies that we use when we're working with clients. And this idea came because we talk to clients on a daily basis about cash flow, and I just know this is an issue out there. So we're just going to put some structure into the concept of cash flow, and go from there, and hopefully you'll have some questions. So what are our objectives today? We're going to talk about several things. One, we're going to define cash flow and its importance. We're going to talk about the difference between cash flow from profitability issues. We oftentimes get phone calls from clients. They think they're having cash flow issues, but they're really having profitability issues. So we're going to talk about that. Once we actually do drill into the cash flow concepts, we're going to talk about tools and strategies for effective cash flow management. Again, I'll just say at the onset, it might be some of these you might say, well, none of this is profound, or I've thought about these things. Simplicity doesn't mean that it's easy. And so I'm just trying to put some structure in place regarding cash flow. So we're going to talk about those strategies. We'll end with a couple things, some actionable steps to ensure success for your business, and we'll end with some tips and tricks, with some Q&A. So let's just keep going here. Why does cash flow matter? And I'm going to throw in a couple quips here that are cliches, a couple of them. Cash is king, and what gets measured gets managed. So we'll talk about those. Sometimes I say those things at the risk of them being overused cliches, but every once in a while I'm reminded that not everybody thinks in those terms. So let's talk about a couple of those. What gets measured gets managed. I've actually want to drill into that a little bit more, because I've actually had clients recently say, whoa, we've never really thought about that. So drilling into that, what gets measured gets managed, I would actually expand on that by saying what gets measured gives you, as the business owner, an opportunity to manage. So there is still decision making that needs to be made, but I encourage clients that I work with to really operate their business from a data perspective. So you need to have good data in front of you, not flying by the seat of your pants, not just running on a hunch in your gut, which is absolutely common, and I completely understand that. But as your business grows, I think it's important to really start to put data structure in place and to use that data to manage your business and make decisions. But to do that, you have to measure and put structure and put processes in place so that you can have that data. So what gets measured gets managed really should be what gets measured gives you the opportunity to have the data you need to manage your business. So I hope that makes sense. Cash is king. In a perfect world, you would provide a service to a business, money comes in, and then as that money is in the bank, then you pay your payroll, you pay your vendors, you pay yourself, you pay banks if you have debt. But if you've been in business long enough, you know that that flow of activity doesn't happen that simple. If it did, we probably wouldn't be talking. You get your money in, you pay your people from those monies, but the reality is that's not the way it happens. Oftentimes, you need to pay payroll before you actually have the money that you are earning as you're working with clients. So that's the rub that comes when you're managing cash flow. So there needs to be cash in the bank to float that activity that is a requirement before you receive the money from the bank. And doing that in an effective way, one, getting the money as quick as possible from your clients or customers in terms of good terms, in good billing terms, is important, but also just managing that process in an effective way. I've talked to clients and they're wanting to build reserves, and I reiterate that your cash reserves, which I think is important to have, building up cash reserves, and we'll talk about that. That money comes from really three areas. That money comes from, number one, money out of your pocket, taking money out of your pocket, putting it in the bank and in the business bank and operating from that. Number two, obtaining loans from banks or using lines of credit or credit cards, but that's another way to have spending power. And three, building up cash reserves really comes from profits. So those are your options. And I say in here, profits that are delayed due to poor payment terms are not helpful. I've had many instances where a client is on their P&L statement. They're showing profits, but they don't have any cash. And what they probably have, a couple things. They probably either have large amounts of money due from clients. That's good, but it's not helpful if you need to pay payroll, you need the cash. Or maybe I've had many instances where their P&L that is showing large profitability and their balance sheet is not showing any cash. That might be because of bad accounting. I've had that very situation multiple times. The P&L is not accurate, and that is causing them to draw conclusions that aren't real. So just understanding that's the perspective, and that's what you're needing to manage as a business owner. Without that cash, as this says, businesses cannot meet their obligations like payroll bills. You can't invest in growth. You can't provide a return to owners. So if you're in a hole, I've had clients where we talk about that. If you're in a hole, the way you get out of that hole is to right size your business so that you are profitable, using those profits and managing billing terms in an effective way to build up reserves, not spending it all and not putting it into your own pocket in distribution form. But those are important things. So let's just keep going, and I hope that concept makes sense for you. As I say in this slide, very often we get called in when a client is having cash flow issues. They're having problems. They are either not understanding their data, they're struggling to get financing, they're growing, there's chaos, they're a sole proprietor perhaps, and they're wearing all the hats. I talk in those terms a lot. They're wearing all the hats. They're wearing the vision hat, the operations hat, the sales hat, the bookkeeping hat, the hiring hat. They're wearing all these hats. And at some point, a growing business needs to start leveraging those hats. And usually it comes from some sort of pain. So we get a call. We're having cash flow problems. Maybe they're having some accounting and financial reporting problems, but it oftentimes does come from cash flow, which is why we're talking about this today. So we drill into it. They think they're having cash flow problems, but they're really having profitability problems. So what's the difference between these two? Cash flow is a timing mismatch of inflows and outflows. So you're having to pay payroll, and but you have large amounts of monies due from customers or clients that just haven't come in yet. There's a mismatch of inflows and outflows. If all that money came in, you'd have plenty of cash to meet payroll and to meet vendor relationship requirements. But there's just a mismatch of that. That's a cash flow issue, and that's an everyday occurrence, and that's what we're here to talk about. A profitability issue, and I realize the slide here is it might be covered with my camera view. So let me just read this real quick. Not generating enough revenue or controlling expenses, these profits are needed to pay bills and backlog. That's what that says. So even if all the money came in and you had no outstanding invoices or billings from clients, you had all the money in and it still wouldn't be enough to cover your bills. That's a profitability issue. And it's oftentimes masked. Um, you think you're having cash flow issues, but it's really, if all the money came in, you'd still be having problems. That's really a profitability issue. Hope that makes sense. So it's a two-part process to understand that, and certainly we will evaluate that as we're navigating through that. But we start with a cash flow assessment. So what is cash flow management? It's an activity where we're really looking at your actual cash balances. What are the balances in the bank? What are those balances? Projecting future cash needs, and then managing that, anticipating whether you have any problems, and pivoting around what those problems might be. And then if you have those issues, seeking and managing the right amount of capital. Hope that makes sense. I've had many people say, well, we have plenty of cash in the bank. So why would we spend our time doing cash flow projections? We have plenty of cash. We haven't had problems in the past. And I'll just say a couple things. I do encourage people to manage this in one way or the other in some fashion, even if you don't think you have problems, for a few reasons. One, you don't want to wait until there's a problem to start managing this, because that's when it's probably too late. So you want to always be ahead of the game. But two, if you are a growing business, you might have this business for purposes of just earning a living, and that's really a job. But you also might be having as a goal to sell this business in the future, whether that is to leave it for your kids, whether it is to sell it in the future, whatever the reason. um, when there is that possibility, the eventual quarter of your business, the eventual person or ownership group that might be looking at the business, they're going to evaluate your processes, protocols, systems. They're going to want to understand, are you living on a hunch, or are you a data based and a protocol and process based business? If you're not, you're going to have problems selling that business or converting that business to somebody else. So the more you put those processes in place, and this cash flow management is one of those things, the more you'll be prepared for that eventual aspect. So that's why we just say, don't wait until cash is low. I actually think of a story a couple years ago. Somebody called and they said they couldn't meet payroll, and they were asking how could we help them with seeking some financing, et cetera, and help them put a plan in place. And I said, well, when is payroll? When do you need to meet payroll? And they said, well, later this afternoon. And believe me, that happens more often than you would think. And that's a tough situation to be in. So that's why we talk about it in these terms. Getting my cursor over here. All right, who should manage cash flow? And I put this in a couple different buckets: startups and established businesses. Again, I am well aware many startup enterprises, they're focused on just getting clients and serving those clients and making sure they're happy and building referrals, and that's really the focus. You're not focused on building processes, protocols. You're not focused on building an accounting team and all those sort of things. You're really focused on just building that business, and there is a time and a place for that. But one way or another, you are managing cash flow. You might not have any structure in place, but you're managing that cash flow in some fashion. Established businesses, and I say in here that might be covered with my screen, the bottom note, the importance of delegating to ensure focus and expertise, and it's the forest or trees effect. That's the part that's at least covered on my screen. Um, as a business grows, I think this is important to understand. As a business grows, you're a business owner might be wearing all these hats. As the business grows, you start to leverage those hats. Pretty soon, you as the business owner, you will be, if you're a truly growing business, you will be relying on somebody else to manage your daily deposits, managing your expenses, managing the accounting, managing the hiring, managing the marketing and sales. You won't be doing it all, more than likely. And so understanding that and putting those processes in place is important. I also think it's important that the forest or trees effect, when you're in the midst of all of that, you see the trees, you see all the details. And it is a truth. It's something that people don't think about it until they start living it. It's a truth that you will manage your details and manage your data differently when somebody else is compiling that data and handing it to you and asking you to draw conclusions from that data. You will manage that differently when you're not compiling it and when somebody else is compiling it. And I will tell you, your vision, your scope, your view of the world around your business will change when somebody else is helping you evaluate that data. You're just not in the details, and you have data that you trust, and then you're responding to that data. So just understanding that that's your future if you're in a growing business. So uh, some comments about that. All right. So, what is the structure? What do we really mean when we say effective cash flow management? So, we put it into three steps here. Number one, establish a baseline, understand your history, review your past inflows and outflows. And this really takes a keen understanding of your business, the patterns, the anomalies, the hidden activities, the seasonality, etc. Capturing all of that activity in a effective, accurate, and quality way understanding all the nuances of that and having that be pretty active, and then projecting that and as far out as necessary to get past a crunch, especially if you're doing this in a time when you're having a crunch. It would be very easy for me to say, do a 30-day forecast. Well, that might not be enough. You might not see an out of this hole that you're in, assuming you're doing this late in the cycle where you're not being proactive. But if you're in a hole and you're starting this process, you should be projecting out really as far as you need in order to get out of this hole so that you can see what your future is. And so you can draw conclusions from that. And we'll talk about this last bullet point using tools like spreadsheets, data dashboards, key indicators, key performance indicators, and other software that's available. So that's really the process: understanding your history, capturing all your activity, and projecting into the future. Simple, not necessarily easy, but then just remaining disciplined in that. So let's talk about a few examples. So again, it would be very simple if everything was just straight line. You have a new client, they pay you up front, you have those monies in the bank. From that money, you pay your vendors, you pay your payroll, and whatever's left over is yours as a business owner. It's just not that simple. So there are multiple scenarios here that I wanted to talk about that makes that concept more complicated. So the seasonality. Maybe you're a contractor that does a lot of work in the summer. Just thinking off the top of my head, a roofer, for example. It's a truth that a roofer is going to be busier in the summer, in July and August and June, than they are right now in January. And so there are differences in cash flow, and there may be a certain amount of variable costs that flow with that seasonality, but there also might be a certain amount of fixed costs throughout the year that you need to plan for. So understanding that and projecting for that and managing for that is one of the keys to success for a business that has a heavy seasonal period. Rapid growth. So again, this is a scenario if you are a growing business and you're adding new services or you're adding a new location. It's a truth that you are going to have to put out money in advance of the return from sales and managing that process. And a third thing, again, any sort of a business that is trying to build up cash reserves. I've had many people say, well, when we get out of this hole and we pay some of these bills off, or maybe we pay off some debt, we'll finally be in a better place. Well, the only way you're going to stay out of that is managing to profitability, number one, building cash reserves, number two, and managing that on an effective basis with a good plan if there is a misalignment of revenues and expenses. So just wanted to give you a few examples related to that. So what are some of the tools? And we're obviously in the information age, and I'm wanting to tell you there are certainly cash flow tools out there. There are software packages online that are available. I think one of them is, I believe it's called flow.com. And certainly there are other software packages available. If you happen to use QuickBooks, there are some tools available inside QuickBooks. But I will just tell you that if this is new to you, then you might benefit from at least starting with Google Sheets or Excel or some sort of a spreadsheet, which sounds sort of archaic and old-fashioned. But if you're building a spreadsheet, it's going to force you to slow down, think about the assumptions, think about your business, and really dive into the details. So I hope you don't draw conclusions that I'm just old-fashioned and I just always use spreadsheets. But I'm just encouraging you, as you navigate through this process, part of it is learning. And if you think that you're just going to be able to buy a software, click a few buttons, and build some spreadsheets or have some output from these tools, I think you'll be surprised. In my own bank, I have a bank account, and I have a major relationship, a relationship with a major bank, and they're good intentioned, and they give me tools inside my bank account about cash flow activity, and it's interesting, but I wouldn't rely on it because I haven't taken the time in that output. I haven't taken the time to evaluate the assumptions that they're using. And so I would, at the beginning at least, I would want to do some manual development of these tools to make sure that I really understand all the components going into that process. But overarching comment, choose the tools that match your size, complexity, experience, etc. And that's my point there. So let's dive into some practical tips relating to the structure. And I'm going to stop here and see if there are any questions. I'm not seeing any questions, so I'll just rely. If you do have questions, please do speak up through the chat function. So, what are some of the tips for cash flow management? Again, some of this won't necessarily be profound, but it's just putting it into a structure for you to think about, and give you some tools and tips. We have about 10 ideas here. So, following up on late invoices. Go back to my opening comments. When you're a W-2 employee, you may not have ever needed to collect money from clients. You move into a business ownership relationship, and all of a sudden you're needing to actually confront a client and ask them to pay. Maybe they've taken 15 days, 30 days, 60 days. It's a truth that one of the joys of business ownership is having good relationships, but sometimes that also means you have to ask them for clients or for funds, and just following up on those late invoices. Number two, review your expenses, identify and eliminate unnecessary costs. Well, again, that's where, as a sole proprietor business owner, if that is you, the forest versus the tree effect, you might say, well, what are unnecessary expenses? I need all of these vendor relationships. Somebody else might come in and challenge that with some concepts or with some questions and analysis on that. Number three, offer early payment discounts. It's a truth. If it might be beneficial to you if you say somebody owes me $100 in 30 days or 45 days, it might be worth it to you to only collect $95 today as opposed to $100 in 45 days. And there's no right or wrong answer there, but there might be a truth in that. And if you think about credit cards, that's actually what credit cards do for you. You receive $97 today instead of $100 in 3 days or 4 days when the cash would otherwise come in through a check, and through that 3% credit card fee that you are living with. So that concept can apply to other vendor relationships, even outside of the credit card relationship. Number four, streamlining inventory. If you happen to be a business where you are needing to buy product in advance, again, there's a simple example where money goes out the door before money comes in. Managing that is a expertise and a skill set in and of itself. Grocery stores, Walmart, big box retailers, they are experts in managing that inventory and making sure the product they have on hand is moving in a sufficient amount of time so that they are getting the cash when as quickly as possible from that investment. Inventory management really is an investment in the future by doing that. Forecasting your cash flow for the next month. We've talked about that, but we put that on the list. Negotiate supplier terms, extend payment terms to improve cash flow. There are times when you can ask them, can we continue our relationship and still receive product with a promise to pay in 30 days, for example. Number seven, reevaluate credit terms for customers. It's a truth that you might need to convert a relationship from a 30-day payment to an upfront payment. Or maybe if you are a professional service firm or you're a contractor, it's a truth that you might need to ask them for funds upfront so that you can meet payroll, so that you can meet your vendor relationship requirements. And whatever that might mean, just understanding those best practices, understanding what you need in order to manage your business. Number eight, build a cash reserve. So I think it's important. That might sound obvious, but but we work with enough clients where that's sort of a profound concept that we put that on here. So again, your cash is going to come from your own equity infusion. Number two is loans, and number three is not spending all of your profits, but keeping those profits in the business to reinvest into the business. It's a truth that keeping some of that cash there will help you manage that business. It will also make you look more effective as you are eventually talking to suitors if you're selling the business or if you're seeking funding from banks. You don't borrow from a position of, well, actually, we'll just segue into number nine, exploring financing opportunity options. And I think it's great that we put 8 and 9 together. You don't borrow from a position of weakness. You borrow from a position of strength. There's concepts out there, where lenders are criticized because they're giving loans to businesses that don't really need it. And here I am as a business owner. I need a loan. I really need that loan to continue functioning, and I can't get a loan from a bank. And I maybe could have gotten a loan when I was in a stronger position. I didn't need the loan then. Well, the truth is, you borrow from a position of strength, not weakness. So people will draw conclusions about what your financial reporting looks like, what your balance sheet looks like, what your P&L looks like. Are you spending all of your cash, or do you have some cash reserves? So just understanding that as you're exploring financing options. And then number 10, I say set a weekly cash flow review, weekly, daily, monthly, whatever is right for you in putting that process in place, I think is what's important there. So I'm going to fly through a couple different scenarios here again, just to add some additional clarity and color. And in both of my case studies, they're not any one particular instance. I can name names if I needed to, but it's really just a amalgamation of a combination of multiple clients that we've worked with over the years. Again, oftentimes we get called, Karl, we're having cash flow issues. Can you help us? We've done an initial diagnosis, and we're just having slow receivables. We have money that clients or customers. I actually also work with healthcare providers, so it might be patients or payers, and we're just having slow cash flow. Can you help us? And as we dive into it, in this particular scenario, what we found is that there are profitability issues. Two things: there may truly be losses that are causing the problem, where even if all the customer pay came in, it wouldn't be enough. But it also could be data issue, where the accounting and the data that you're using to draw conclusions are not accurate, such that you think you're profitable, but you're really not, or maybe you're break even, and that's going to contribute to a cash flow issue. So in these particular cases, we would put a strategy in place to review your revenue, customer base, unprofitable service lines, fix the data so that at least we can draw conclusions from an accurate set of data, put the right cost structure in place. When that happens with proper cash flow management, conclusions will be drawn based on accurate data, and an effective plan can be executed. There are other instances where there are true cash flow issues. A client calls and says, we're having slow receivables. What do we do about that? What are the best practices that we're missing that we haven't thought of? And in that case, and both of these might happen at the very same time. That happens all the time, and I'm thinking of clients in which we're dealing with that right now. But in this particular case, in this example, the payment terms might be too favorable to a client that will not help you fund the business, paying payroll, etc. So we will put a plan in place to implement stricter payment terms, put this rolling forecast in place, a projection in place, so that you have the data you need to manage the business more effectively. As we start to wind this down, action plan for participants. What are the steps that you need to do in to put all this in place? And we've touched on all these things, but commit to monitoring your cash flow on a weekly or whatever the right rhythm is. Choose a tool to start tracking. I say in this, build a 30-day cash flow forecast. We said earlier, however many days that needs to be, whatever that rhythm needs to be. It might be 30 days, it might be 90 days, it might be a year, but whatever that forecast needs to be to help you know what your future will look like and how to draw conclusions from that. Review and revise your plan monthly or on a regular basis. There will be a time where you might need to seek some professional help. Not always, but hopefully this will give you some tidbits where you can get started on that. Again, I really do believe in the value of the trees versus forest concept. I've seen it in my own life, in my own career, and in my own career, and in working with clients. There will be a time when that will be needed, and so we throw that in there. But hopefully this will give you some kickstart as you begin this process. All right. So let's ask if there are any questions. What are your biggest cash flow challenges? How to apply today's strategies to your business? There might be questions from people listening. I'm also just going to say I anticipate we'll be putting this on YouTube in our playlist, and I'm thinking people will eventually listen to this. So don't hesitate to reach out if that's you, to reach out via our website. You can actually just very simply reach out to info@bakercfoadvisory.com. My email address is Karl, Karl, @bakercfoadvisory.com. Phone numbers will be on there. If you have questions as you've navigated through this process, don't hesitate to reach out here. So I'm going over to see if we have any questions in the chat. I see a comment, a thank you comment, and I really appreciate that. I'll give it a second here, but I'm assuming really that there aren't any questions at this point. But if there are, don't hesitate to reach out. I'm going to end with just again a thank you for your time, whether you listened live today, whether you listen in the future. The fact that you're spending your time with this, we really appreciate. There should be a link somewhere in the chat where you can sign up. If you don't see it here, go to our website and sign up. There is certainly I know there's a newsletter add on there in which you will learn about future webinars. We're going to be doing this right now. We're going to start on a monthly basis, and I've kept this pretty broad. We actually do have a number of client specialties. We work with healthcare providers. We work with nonprofits. We work with contractors. We work with professional services firms that are selling their time. And so we have deep experience in those cases and a number of other cases. And we might, depending on the questions we get and the feedback we get, we can make these more industry specific. We can do them more often. We really just want to be here and be available. That's why this business is in place, is to help you. And so I also want to end with this announcement. Our next webinar is scheduled for Thursday, February 20th at 10 a.m. We're going to be talking about numbers that every business owner needs to track. So I'm not going to just sit here and read definitions of key performance indicators, but we're going to put in a place. We're going to have a discussion around the important numbers, why they matter to you, how to use that data to manage your business, and hopefully it will be germane to you as you listen to this, and it will be helpful to people. I'll pause here and say thank you very much, and we appreciate your time. And with that, we will sign off. Thank you.